Let me now show you why I think REITs will deliver huge outsized returns in the near future once rates start getting cut. Basically, what I expect is the reverse reaction of what happened in 22 and 23 when the rates were getting raised by the Fed. So the reason why REITs fail will be the reason they go up. Here is why. First, because of the lowering of the risk-free rate. As you remember, the risk-free rate is what investors get from investments like money market funds and government bonds. This forms their expectations for the yields and returns on any other investment. When the rates fall, the interest on bonds will fall as well, which will mean that if right now an investor is happy to sit in 5% yielding money market fund and demands at least 6% from a REIT, their expectation will change when the money market fund starts giving them 2%. In that case, they will look for a better return on their money, and the higher dividends that REITs pay will start looking attractive again. If you're getting value out of this video, press the like button and also subscribe to the channel so you don't miss any future videos like these instead of relying on the algorithm to randomly serve them to you. So here is the second reason why I think REITs will perform great once rates get cut. Remember that REITs used a lot of debt to finance the purchase of their real estate? Well, one of the big issues with the raising of rates was that this debt will become more expensive. If this was the market expectation then, it is completely logical that when rates start going down, investors will flood into REITs because now these companies will have access to cheaper debt, allowing them to grow faster. A third reason REITs will make massive gains, in my opinion, is that they will simply overshoot. Because of the irrational sell-off in 22 and 23, the reverse reaction will probably be equally irrational to the upside. We all know that markets are prone to wild swings that way overshoot in each direction, and as investors, we can take advantage of it. Actually, this is not just theory, but was proven in the last months of 2023. What happened was that the market started believing that the Fed may be done raising interest rates as inflation cools and economic growth slows. As a result, REITs had their fifth best monthly return ever in November 2023. This was turbocharged by Fed Chair Jerome Powell's comments in December about cutting rates in 2024. This led to an almost 22% rally in the span of 2 months in November and December for the real estate sector compared to 12.5% for the S&P 500. In my opinion, this is a sign of things to come. Imagine if this was the result of just a hint at cutting interest rates, what will actually happen when the first rate cut comes. Before we get into the part where I prove to you what happens with REITs when rates are cut by showing you research about the past, a minor reason why investors might favor REITs in the next few years is the fact that higher rates have led to a lowering of the supply of new buildings. Obviously, this varies location by location and sector by sector, but in general, when you have a prolonged period of low rates, a lot of new buildings are being built because capital is cheap. This happened in a lot of places during the pandemic. However, the reverse is also true. Because of the high rates in recent years, it has been harder to finance properties, which will lead to less new competition for the existing buildings the REITs own. Now, if all of this is a little over your head and you want a more beginner-friendly explanation of all the investing concepts I have been talking about, then I invite you to my free investing masterclass, which you can sign up for in the link in the description. It is an event where I explore investing for financial freedom, how our money works, and answer questions. By the end of it, I also introduce my Dividend method program, in which I have a dedicated lesson for investing in real estate investment trusts, which you can join if you wish to. Alright, it's time to look at some research on how have REITs behaved in situations like this in the past. I will show you that everything I have talked about is not just theory, but has already happened in previous economic cycles. As you can see from this research, REITs usually outperform the general stock market and private real estate significantly when the Fed has stopped the raising of rates. Now, I want to be clear here that this is a historical comparison, which means that the data has been taken when it had been clear that the Federal Reserve has already stopped. When they hold rates at the same place like they have had for the past months, I wouldn't consider this an end of the rate hiking cycle because the market is still confused on what they will do next. So I'm guessing this data has been gathered from periods when it was official and clear that they have stopped hiking or actually beginning to cut rates, which is really hard to pinpoint when you are actually within the cycle right now. Regardless, let's go back to the research. Private real estate is in light blue, the stock market represented by the S&P 500 is in gray and REITs are in dark blue. You can see how during the first 1, 2, and 4 quarters after the hikes have ended, REITs are delivering better returns than both private real estate and the S&P 500. Another research here shows clearly how REITs crushed the stock market 6 months after the rate hikes have ended, beating it with almost double the return. The interesting point about this research is how this is actually very consistent with what we saw in the fall of 2023, as I already showed, when the market thought that the Fed had finished raising rates and the real estate sector exploded, beating the S&P 500 with a significant margin. So here we have 2 data points converging: the historical behavior we have and also the real-time data we got from the most recent example. To me, this is a very powerful overlapping of data points. Now, I don't want anyone to think that I, you, or anyone else can time this exactly, but I honestly don't need to. I think it is obvious that we are getting closer and closer to rate cuts, and whether that happens in the next 3 or 9 months is irrelevant to me, as I can just sit in quality REITs that pay me rising dividends and wait for the opportunity. Speaking of that, I think we are seeing more and more signs of this moment approaching. Several articles and studies have been pointing towards that in recent months, like this one of the asset manager Vanek, which talks about the REIT recovery of 2024, this one of Morningstar pointing towards significant discounts in the REITs, and also the most recent economic data that came out, which increased the chances of a near-term rate cut. The USA economy added fewer jobs and jobless claims rose, which led to an outperformance of real estate stocks for the 2nd straight week compared to the rest of the stock market. Now, as I said, I don't want you to think that the timing is certain and you will find the exact bottom of the market just before it shoots up, because usually you won't. But my theory is that we should try to be directionally correct, not time the market with exact precision. When it comes to the specific sectors within the REIT market, I'm hesitant to make huge bets, as my strategy is to pick fundamentally good companies that I'm happy to own long term. That way, even if my thesis is incorrect, I might lag the market, but I will be generally fine and my dividends will keep coming. But if I'm right, I will make huge capital gains, which I always see as a bonus, not the main goal. However, if we look at the most recent example I talked about in the last month of 2023, here is the performance of the different sectors. This is just a part of my thesis about how to get rich with REITs. To watch the full version, click on the video that should have appeared on your screen right now.